a chance to bring you up to date with the Pengana International Equities. That's ticker PIA on the ASX. My name's Tim Richardson. I'm Pengana's Global Equity Investment Specialist based here in Sydney. We'll shortly be joined by Rick Smith, Co-Portfolio Manager, and Ray Vars, Portfolio Specialist, who work in Harding Loevner's Global Equity team over in New Jersey. It's a really exciting time in the global equity market, and it's great that so many of you have been able to join today's call. Rick and Ray are going to run through their quality growth investment style and explain where they're finding some really great opportunities in the market at the moment. Now, we do recognise that the PIA share price currently trades at a discount to the net tangible asset value. This is not uncommon for listed investment company discounts to expand from time to time. Now, while the current discount represents an attractive opportunity for new investments, it's nonetheless something that we're actively addressing through several initiatives. Our capital management strategy includes paying consistent quarterly fully franked dividends, and this is supported by a healthy profit and franking credit reserve. The current cash yield is 4.7% or 6.7% when it's grossed up for the franking credits. Dividend yield is not impacted by the level of the discount. Also, we try to proactively engage and communicate with stockbrokers, financial planners, and other significant investors to highlight the market opportunity of PIA at the present time. We conduct regular webinar updates like we're doing today, and we host roadshows with a range of investors and financial intermediaries when our colleagues from Harding Loevner visit Australia. Future performance of the underlying portfolio is in practice expected to influence the discount level. Market outlook, which Rick and Ray are going to outline, provides some pretty good grounds for optimism. Presentation is going to run for about 20 minutes or so. We should leave plenty of time for questions afterwards. I really do encourage you to ask any questions that you might have. And you can do so by entering them via the Q&A icon at the bottom of your screen at any point in the webinar. With that, I'll hand over to Rick and Ray.
Let me start with a bit of a background on how we go about investing at Harding Loevner. We believe that investing in high quality, growing businesses at reasonable prices can lead to superior long-term risk-adjusted returns. And that same approach is what we've been doing and implementing since 1989 in global equity portfolios for our clients. So we manage about $50 billion on behalf of clients, but I would say we're kind of a focused boutique. We basically just do this one thing, investing in great businesses through long-only equity portfolios on a global basis, and we've been doing it for a long time. I think the terms quality and growth get thrown around a lot. Of course, everybody likes quality, but what do they actually mean? We try to be as objective as possible about quality here at Harding Loevner. So for us, a quality business is a company that can generate above average profitability and maintain it over time through some sort of competitive advantage, not through financial engineering. So our companies tend to be strong businesses. Maybe they have pricing power, economies of scale, brands that give them that pricing power, something to drive that profitability, whereas the balance sheet tends to be strong, lower levels of leverage, strong free cash flow generation. So for us, that's quality, strong, profitable businesses. Growth, we're not trying to outguess other investors or figure out next quarter's earnings. We're really looking out over the next 5-10 years. Can a business compound that great profitability in the long term to drive value of their business? And we think that ultimately will drive value of the stock. The third component, which doesn't show up here on this chart of quality metrics and growth metrics, is valuation, sort of the third leg to the stool. You can find a great business, but if you overpay for its shares, you won't be rewarded as a shareholder over time. And I think another distinguishing feature about our approach is that we do it on a truly global basis across all sectors and markets. So I think a lot of people who hear a quality growth manager, they end up with a manager that invests basically in staples, healthcare, and tech, and nothing beyond it. Our portfolio, we're finding companies in the US, but into emerging markets, obviously in places like healthcare and staples, but also in industrials and even high quality financials. So I think that's a distinguishing feature that's led to good, strong performance over the long run. We organize our research to find these great businesses from the bottom up on a global sector basis. So our analysts pictured here, we have 30 of them, primarily focus their research sector by sector and industry by industry. That helps them understand the competitive structure in which each of these companies operate. So can they sustain that profitability? Is there a peer or a challenger or a competitor in its industry that might eat away at that? So it's important to us to have analysts that understand the businesses and the industries in which they operate, identify those great businesses, and from that pool of companies identified by our analysts, our portfolio managers are constructing portfolios of their best ideas to outperform the global benchmark. So maybe I'll stop there and let Rick give a little bit more information about the process through which we go about finding these great businesses.
Thank you, Ray, and thank all of you for joining us today to learn a little bit about Harding Loevner and the portfolio we have. So I'm going to talk a bit about the process. On the left, you'll see it describes how we go from the research universe, 5,500 companies we could invest in, to the 60 or 70 that we do. Now, don't worry, I'm not going to go through each step of our process. I'm going to try to focus on some of the highlights, which we have put on the right-hand side. There are 4 C's, we call them, our 4 key criteria that every company that we look at must meet, all 4, before we'll even consider investing. In fact, even before we look at the share price of the companies. These 4 echo what you heard from Ray. We look first and foremost from the industry for a competitive advantage. Here we use Michael Porter's work, started long ago, 1979, a book called Competitive Strategy, and the 5 Forces framework provides a language that we use throughout the firm. We want those long-term growth stocks, and we want the financial strength, the great balance sheets and cash flow that basically allow our companies to achieve that growth through a potential downturn. And finally, we want management who are executing to benefit shareholders. So I don't think any of those are that surprising. The challenge as an organization is to implement that in a structured way, a repeatable way, and that is what we think has led to our investment advantage, an organizational advantage. And the next slide talks a bit about what we think is our secret sauce. It includes a term that we use a lot called collaboration without consensus. By collaboration, we don't want people to get together to agree. We're looking for people to work together to challenge investment theses, to hone the investment ideas, to push and pull our colleagues to get the best decision making. That's important because we are big students of behavioral finance, and we want to capture the benefits of the group, the wisdom of the crowd, without detracting in decision making with groupthink. So the way we do that is structure both our research analysts, our research process, and our portfolio construction and our portfolio managers in a similar fashion. We do 2 things. First of all of our decision making and discussions are transparent. We email and have any discussion sent to the entire group, tagged and stored. So we can go back and look at decisions, because I promise you, a decision I made a year ago, my thinking of why I made that decision, the hindsight bias is so strong. It is almost certainly not going to be what I think it is today when I look back. That's one of the ways we're a learning organization and can learn. The second aspect of the process is individual accountability. So every investment decision in a Harding Loevner portfolio, in your portfolio, is the result of an individual accountable decision. We don't have group decisions. Each stock from an analyst, each stock in the portfolio is the result of a single individual's experience and decision making, and they're accountable for it. They're measured against it. And that's why we think we're able to keep some of the negative biases that come from, that we've learned about from behavioral finance, out of our system.
And over the last year, and really over the last couple of years, global markets have continued their march higher. In fact, I think the global equity markets hit their all-time high in late September. And our portfolio and the PIA portfolio has achieved strong absolute performance for the last 2 years, but we've generated disappointing relative performance, particularly during the 3 years in which we've managed the PIA portfolio. That poor 3 year relative performance was really a function of style headwinds in 2022, compounded by some of our own poor stock selection. Prior to that, the strategy had a long history of delivering consistent risk-adjusted outperformance for our clients. What we're looking at here is actually the annual performance year by year, going back, actually quarterly performance, excess performance going back more than a decade in the top chart. And down below, we're looking at that rolling quarterly performance on a rolling 3 year basis. And a couple things stand out. That consistent performance I talked about prior to 2021. In fact, Harding Loevner had handily outperformed the MSCI All Country World Index for the trailing 3, 5, and 10 years as of the end of 2021. And in the chart below, you can see we outperformed for every rolling 3 year period quarterly since 2015. However, since late 2021, our results have been disappointing, primarily as a function of 2022 underperformance, where we underperformed by over 1,100 basis points in that year alone. And that's boxed there, where we saw rates rise sharply. We saw a sharp rotation away from growth into value. Our portfolio, in hindsight, the valuations were a bit too stretched. We were too tolerant of the prices we were paying for some of the shares. And some others we were wrong about the investment thesis. And so I'd say about half was due to style, about half due to stock selection for that underperformance in 2022. What we reflected on those decisions, we looked at the businesses we owned, and like we've done historically, we've adhered to the philosophy and we stuck with a number of very strong businesses where the stocks were hard hit. And in fact, in 2023, 9 of the top 10 performers were actually some of the underperformers in 2022. So again, sticking with those great businesses helped. Unfortunately, we didn't capture all of that strong performance because of our holdings in 2 U.S. regional banks in 2023. Now, obviously, we're disappointed that we haven't done better over that period of time. But as Rick alluded to, part of the benefit of the transparency in which we operate, the way we record decisions, we reflect on the decisions we made, and we think we've made improvements to our process. We've developed a couple tools that we think will be helpful in future sell decision making in particular, as well as the overall risk profile of the portfolio. One thing that's unwavering and will never change is our philosophy. And we think that our focus on great businesses and that stock selection, we're confident is going to drive performance back to those pre-2022, 2021 levels that we have generated historically. So with that, let's turn to the current environment and how the portfolio is positioned to hopefully drive future returns. So in the current environment, obviously, as I mentioned, markets steadily moved higher. Perceived risks also seem to fall to all-time lows. What we've done here is we've looked at the inflation and interest rates using the U.S. Federal Reserve rate as a proxy for risk-free rates around the world. We can see that off to the right. Part of what supported the performance was a dip in inflation. Seems like maybe that's under control and coming down around the world. We also saw the ECB and the U.S. Fed cut rates. So those are supportive returns. But what's surprising is how little of the perceived risks in the marketplace and some of the volatility we witnessed not long ago is not discounted in either the valuations or reflected in measures of risk like the VIX, that chart to the right, stock market volatility. We can see a spike back in August. It's easy to forget, but Japan, their central bank actually raised rates on August 2nd, and it led to a flash crash. The Topix fell over 12% in one day, the biggest decline ever in Japan, and we saw that reverberate around the world. But that seemed to be quickly forgotten with those rate cuts and inflation data that came through later. And the VIX fell back to the sort of all-time lows. To us, it feels like perhaps there's a little bit of a disconnect, maybe some complacency in the market. It's hard not to see some risks out there. Clearly, there's still conflict in the Middle East and the Ukraine. Trade tensions between the US, China, and even other countries seems to continue to ratchet higher. And we even have an election coming up here in the US that some people are worried about. So it does feel like the market is discounting very little of those risks. Um, However, I'd say in the most recent quarter in particular, it feels like maybe there's some changes afoot in the marketplace. And so maybe I'll turn it back to Rick to talk about how we've positioned the portfolio in this environment and some of the stocks that we're excited about.
Thanks, Ray. And I'm going to talk about how the portfolio looked at the end of the third quarter. And I think you're going to see here not only how differentiated we are. I don't think this is a portfolio that you see from a lot of global growth managers, but also try to give you some of the understanding behind our decision making. So one of the things Ray talked about was how not only are we a quality growth manager, but we want to buy at a reasonable price. So we respond to the stock price. We take what the market gives us. And if you see on the right the geographical breakdown, now this classification shows us overweight North America. That actually includes a couple of companies that are not US companies, but listed in the US. So our US exposure in this portfolio is underweight. We have about a 61% exposure to the US versus 64 for the index. And that's something that has been gradually occurring over time. We didn't make a decision that we didn't like the US and we want to be underweight. What happened from the bottom up, there were a number of stocks that we felt were getting too expensive and we sold them from the portfolio. And sure enough, today we're underweight the US. I think, trying to reflect some of the things that Ray mentioned about risks not being in the market, those places where have done the best, I think are probably those where the discounting of those risks is the least. So I like the fact that we're overweight places where the prices haven't done so well. On the left-hand side, you see our weights by sector or industry. Now we are, as a bottom-up business, focused first and foremost on industries, but just like countries, we don't go out and decide we want to be overweight the healthcare industry, we want to be overweight industrials. What we do is, from the bottom up, build our portfolios. Where are the best opportunities? Similar to what's happening in the US, and sometimes with the same companies, IT, information technology, is a sector we've long been overweight, but in the last year or two, we've been selling some of our biggest and a number of our IT stocks, and we're now underweight the sector. And you'll see that we're overweight, again, some places I think not a lot of growth managers usually are, those industrials, communication services, and healthcare. Let me dig deeper into two of those sectors. I talked about IT, and what's interesting to us, of course, IT has been driving the market. Everyone knows what's been happening, I think, with AI and how particularly the companies that are providing the hardware, the chips, have been driving not only the US market, but the global stock market. NVIDIA is the poster child for this. ASML is another company, both of which we used to own. So every logo you see on this wave chart, I'll talk about what it means, is a company that we now own, except NVIDIA and ASML we've sold. I'm going to talk about how that differentiates our IT exposure. So on the left, you can see that we are underweight hardware, we're underweight semiconductors, but actually we have a significant overweight in the software and services aspect of IT. Why is that? There's been a number of academic studies talking about how innovations are monetized, and we put it in a picture and call it a tsunami. But basically, you start with the first monetization in those hardware companies. Then it moves to the platforms, the hyperscalers, frankly, in this situation. And eventually it moves to the applications, the IT services companies, the software companies. So our exposure and the way we are investing in AI today is reflecting what the market gives us. We like all of these businesses. All of them were in the portfolio or are today. But when we look at the share prices, we think the growth is less discounted in that second wave and third wave. And that's how we've positioned the portfolio. Now, particularly in NVIDIA's case, we owned it for 6 years and sold our last holding in NVIDIA in February after making over those 6 years, I think 13 times our money. Of course, NVIDIA's been much stronger ever since, so it was a mistake. We sold too early. ASML, fortunately, our timing is a little better. Maybe we're a little luckier. We sold our last position in ASML in August. And what happened with them is what I think will happen eventually to any company that has too high of expectations in the share price. Something will change, be it a poor earnings announcement or even a good earnings announcement that doesn't meet expectations. So last week, ASML announced and the share price fell 10, 12% or something because the expectations were too high. For us, I think the software businesses, they must monetize in order to drive the growth in the infrastructure companies. And because the share prices aren't reflecting that, that's where we've put our overweights. We have a similar chart and concept in healthcare, which is actually our biggest overweight. And just like a little bit, we'll stretch it a bit, but you can see while we're overweight pharmaceuticals, the traditional big pharma, we're actually underweight. We've instead found businesses in biotech. I'm going to talk about one in a bit, and life sciences and tools and services. Another aspect of the business that has grown quite consistently, sort of mid-single digit, high single digit over many years. Then they actually boomed during the COVID period. So from 2020 to 2022, we saw huge demand, not only from people looking to find a vaccine and the demand they needed the products to help do the research, but also all the supply chain issues meant that people brought forward orders and made sure they had enough in place. In 2023, things normalized. People used up that inventory, and the sales of our life science tools and services companies declined. The market, of course, reacted to that and said, oh my gosh, is that long-term growth aspect of these businesses broken? Our analyst dug in, spoke to the companies, spoke to the industry experts, and we took a view that the growth is going to come back and added to all three of our companies, Thermo Fisher, Danaher, two of the market leaders, Repligen, a more specialist provider of services. And so far, the results that are starting to come out suggest that it is working. So our expectation that the growth is going to go back and much more, again, you can hear me talk about market expectations. The market overreacted when things were doing well and overreacted the other way when things weren't doing so well. We took advantage of that and added to our positions, which is one of our biggest overweights. You can see our 10 largest positions by active weight on this page. Many of these companies I think you'll be familiar with, some you may not. What I love about them is they are a diversified mix of idiosyncratic growth companies. We don't have a single driver that is going to move our entire portfolio. We don't build our portfolio around themes. We build it around companies. We can draw out some themes, but what I see in each of these is a fantastically interesting business that meets our quality growth criteria. Let me talk about two of them, which happen to be our two largest holdings. One is Schneider Electric, which is a company that supplies electrical equipment and services, things like transformers and motors. It's the world leader, based in France. We didn't go out and look for a French company. I don't have any view on the French economy. We simply found a wonderful growth business and the market leader that happened to be listed in a place that maybe allowed us to get a bit of a better price. It has a fantastic competitive advantage and benefiting from a number of tailwinds that are occurring in its industry. The competitive advantage basically comes from scale and also the brand value. So one of the tailwinds recently are people building out these AI data centers. So, these things cost $1 billion, and they're highly dependent upon their energy system, their power. So if you're spending $10 million, you're not going to try to negotiate a better price and play Schneider off against the number 2 or 3 or 4 or 6 player. You want a company whose products work, who's been around, and who'll stand behind it. So Schneider's been a huge beneficiary just recently of this trend, but 2 longer term trends are what we're more interested in: electrification and industrial automation. Seems like this is a very, very long runway. Now, a very different business is Vertex. It's that biotech pharmaceutical. They developed a drug that treats cystic fibrosis, a horrible disease, usually diagnosed very young, early, mainly in women and girls. Usually are diagnosed around 2 or 3. Historically, it was a death sentence. Most life expectancy was 5 to 15 years. Horrible. They, through their focus on trying to treat with the causal biology, that's their expertise, develop drugs, and then increasing their expertise. So they have launched drug after drug after drug in cystic fibrosis, such that the life expectancy it's a miracle. It's now 55, and every year, 55 years of age, and every year pushing out better and better. Pretty soon it's going to be effectively a chronic disease where people need to be treated, but no limitations on lifespan. So that's a great business. But then Vertex has also started to apply that platform, how they look at the diseases, look at the market to new diseases. So sickle cell anemia is one area that they've been looking at and launching a drug into studies. And the one that to me is most exciting is pain relief. So historically, pain relief has been treated with opioids. We know it's created a crisis. We know it's had horrible side effects from addiction. What Vertex does is, unlike opioids, which treats the pain in the brain, that's why it's so addictive, Vertex treats the pain at the nerve endings. So it's not as addictive, and it's going to be a fantastic drug. It's not approved yet. They're on the way. We're pretty comfortable with where they stand. They have a number of other drugs in the process, but this is the kind of business where we see success in one applying to a platform that could be used in more and more drugs. Another one of our quality growth businesses that we think has a great structural tailwind of demand.
Before we open it up for questions, I'll zoom back out to the portfolio level, and some of these great businesses that Rick mentioned, as we roll up the characteristics, we roll those up to the portfolio level and look at the overall quality and growth metrics of the portfolio. We've charted that on the left here. So there's the quality growth metrics of the portfolio in the light blue versus the benchmark in gray. And what you can see is this portfolio has consistently exhibited higher quality, higher growth attributes in the market. So more profitable businesses that are growing faster than average. And that is not going to change. What we see to the right is what gives us some confidence going forward as well, is the price we're paying relative has come down quite a bit. So there's a valuation of the portfolio relative to the overall market. So as it's rising, we're getting more expensive. As it's coming down, we're getting cheaper. And so if we flash back to 2021, you can see the valuation was pretty stretched as we saw that violent rotation from growth to value that hurt performance. But more recently, through the transactions, through stock by stock decisions that Rick and Jingy and the other team have been making, we've taken down the valuation while maintaining that quality growth attribute. And as we think about sort of the broader markets, central banks, company managements, investors like us are all trying to figure out if what we're experiencing is sort of a post-pandemic normalization, like we're talking about in healthcare, or an economic slowdown, or there's uncertainties out there, whether it's trade tensions or the election uncertainty in the U.S. A lot of those things we're all trying to figure out. But to us, I guess when we look ahead, it seems like what might be most likely is a world where it's not driven by any great economic growth. We'll see modest growth, modest inflation. Rates might tick down, but they're now going back to zero. So the cost of capital is going to matter. The interest rates companies pay are going to matter. And in that environment, we expect the types of companies in which we invest, the ones whose organic growth, can drive growth, not dependent on the economy, strong balance sheets to be able to reinvest in their businesses, high margins, strong cash flows. We think those type of companies, even in a difficult market environment, can deliver good fundamental and relative results. And we think at the prices we're paying for their shares, that leads to a combination that we think can outperform going forward. So with that, maybe we can turn it back to you, Tim, to navigate any questions that have come in as we've been speaking.
Thanks very much, Ray, and thanks, Rick, for what was a very thorough and encouraging update. We've had a number of questions come in, but just as a reminder to those on the call, if you do want to ask a question, there's still time to enter it there's a Q&A box at the bottom of your screen. The first question, what investment themes are you exposed to? Now, while it's not a thematic fund, maybe Rick, you could have a shot at that one.
Sure. And you noted what I talked about earlier. The CIO at Harding Loevner doesn't come out and say, this is a theme we're going to invest in. Please fill a bucket of theme A, fill a bucket of theme B. We start with the coverage of our universe and build up our stocks. But you can see in the result some themes that develop, and that's because there's some structural growth drivers that apply to different businesses and different industries. And the industrial ones that I mentioned are probably some of the most significant: electrification, factory automation, that affects some of our tech stocks, it affects some of our industrial stocks, and the continued digitalization. We see it clearly in the IT sector, but even in things like our financial stocks. So there are some things that when we go back and look, you can see themes in the portfolio.
Thanks, Rick. Another one that's come in. What's your perspective on the US election? Have you run sensitivity analysis on what might occur if either Harris or Trump wins? Has your view led to your recent underweighting of the US region?
So we don't have a view. I think anyone honestly would have to say it's a coin flip right now. The sensitivity analysis, I think, is extremely difficult and probably maybe gives you something you feel very comfortable about. But the reality is we just have to look back to the last Trump victory. If anyone would have predicted that, I'm pretty sure the result, what they would have done in their portfolio is different than what happened in the markets. But you're right to point out we've reduced our exposure to the US. That's not a reflection of, is it Harris, is it Trump? It's a reflection of the fact that, wow, these prices are rising and there's a lot of risks going on in the market that are not being discounted. So again, stock by stock, started to say this stock looks expensive versus what could potentially go wrong. Sure enough, at the end of the quarter, every quarter for the last three, our US weight has gone down. Personally, I like volatility. I think it's an opportunity. So if we start to see something in 12 days, we have a little firepower in the US that we can look for great businesses that we think won't be affected.
Thanks, Rick. Another one that's come in. PIA's portfolio volatility over the shorter term period has been higher than the market. What's been driving this increased volatility over the shorter term?
I have to check those numbers. Ray, do you?
Yeah, I was going to say maybe in the very short term, it's ticked up a little bit recently, but I'd say if we look back over the last 3 years, based on our sort of risk models, our forecasted tracking error, beta, those sorts of benchmark sensitive volatility measures were actually more stretched going back 2 or 3 years ago. So along with that chart where I showed the valuations have ticked down through some of the transactions in the portfolio, on our risk tools, looking at sort of forecast beta and things like that, not that we're trying to dial down to a certain level. I think that some of the changes we've made stock by stock, some of those stocks that Rick talked about, that diversification, having different drivers, that's actually led to, on our models, actually a downtick in some of those volatility measures going forward. We'll see. I think another factor is just the market itself. There's been such concentration of returns recently, sort of AI related stocks, particularly in the US, and really momentum driving a lot of that. I think as we've seen a crack in some of those things, that might have made some of the market relative things tick up a bit in the very short term. But again, we think that that's actually that shifting environment. We're well positioned to deliver more consistent, lower volatility than we have historically, and we'll see hopefully better performance as well.
Thanks, Ray. On here, how sensitive is the portfolio to the oil price, given it's underweight to the energy sector?
Sure. So we're not structurally underweight. We do buy some energy businesses. The challenge has been for us as quality growth to find pricing power. So we really need to find a business that doesn't. We don't want a business that just depends on what the oil price is going to do. I don't think I can predict the oil price. I think it's extremely difficult for anyone. But if I can find a business that we think is structurally adding reserves or has an ability, or historically we've been able to find some companies that are supplying. Now, of course, in PIA there are some restrictions here, so we will always have a bit of a underweight to the oil sector. I think my own view is the sensitivity of the global economy has been reduced. In addition, the oil market has seemed to become less volatile. I mean, you think of what's going on in the Middle East today, and the oil price is lower than it was a year ago. I would never have guessed that were to happen. So if there was to be a big oil shock out there, I think most of our companies are strong enough, definitely from a quality and balance sheet point of view, and even from a earnings power point of view, to work their way through it.
Thanks. One other one here. Can you elaborate on the enhancements that have been made to the process?
Sure. So we made two, and both of them are. I mentioned how we're students of behavioral finance, but we made some mistakes which reflected the endowment effect. We owned businesses for over a decade in which we were rewarded in the past for sticking with them. We've decided that we need to become faster and quicker and change our minds more. So the two enhancements, one is we call it a torpedo tracker. It's actually named after an academic work about growth torpedoes, and that's on a stock level. It's a quantitative model that uses some market signals, not just the fundamental signals that we normally use, and raises a flag, a warning. We want to amplify some of the disconfirming evidence on the companies we own, and we think that would have helped a lot in some of those stock selection ideas. Now, Ray also mentioned that the other aspect of our performance has been hurt by style, and we've implemented another quantitative tool, which we always had in a quarterly basis, but we've brought it into a real-time desktop analysis for portfolio managers to understand the factors of our risk. So we love data, but we're not a quant shop. What we want to do is understand the risks we're taking. We don't build portfolios to meet those risks, but when we look at the portfolio, we want to understand them. This tool now makes it real time, and we think that will help us a lot going forward.
Thanks, Rick. I think probably we'll make this the last question. You're not currently invested in Novo Nordisk or Eli Lilly, the weight loss drugs. What would have to happen for you to change your view on those?
So the rationale for not owning them is similar to what you've heard me talk about, and maybe even in the, seems odd, but even in the semiconductors. They're great businesses. They have fantastic innovations. They've just gotten extremely expensive. They also have patents that come off, I think 2032 for Novo and a similar time for Lilly. And there's a lot of new anti-obesity drugs that are in phase 2 and phase 3 studies. We think that the profitability that these companies are achieving now is probably the expectations are too high in the market. So there's two ways that we could see ourselves owning them. Expectations reverse, just like I talked about for others. Now that's a less cyclical business, so My own expectation is probably it's less likely than we would see that we see a recovery again after NVIDIA, because once you have these new drugs come out, those prices are going to come down. But we'd respond to price, and of course we'd always respond to we're wrong. These 20-something plus drugs under study aren't working, and the duopoly market share between these two companies is maintained. Well, then we'd have to reconsider our investment case.
Thanks, Rick. Now, in the interest of time, I think I'm going to bring the webinar to a close, but thanks to everybody who submitted questions. We didn't manage to get through all of them, but for those of you who didn't hear your question or a version of it, we will get back to you directly. What I think, though, Rick and Ray have showed today was the value of a quality global equity portfolio as the global interest rates normalise, but the macro risks remain a bit elevated. In particular, they showed why the fund has a differentiated exposure to the waves of innovation that we're currently seeing in AI. Our next webinar in the series will be next Tuesday, 29th of October at 11 a.m. With Nehemiah Richardson, who's CEO of Pengana Credit, who will talk about the Pengana Global Credit Trust. Please do RSVP for that if you haven't already done so via the website. We'll send you a link, which makes it easy to join the webinar. With that, thanks again for attending. Please enjoy the rest of your day.